Welcome back to another episode of the No Money Real Estate Podcast. And today we're going to unpack the secret to building a big real estate portfolio. I get people that ask me this question all the time, and people really wonder how I did it, how I built a $100 million real estate portfolio in the last 8 years. And I'm going to unpack it for you right after this.
Hey, my name's Ken Dunn, and I'm a real estate investor. I want to welcome you to the No Money Real Estate Podcast. On this show, I'm going to interview elite level real estate investors from all over North America, and I'm going to help you to see one thing that all successful real estate investors have in common. They built their portfolios without using a dime of their own money. I've got a portfolio of $300 million in real estate. That includes resorts, apartment buildings, commercial buildings, and I've built the entire portfolio without using a dime of my own money. Real estate is a business that anybody can get into, but the strategies that those tight real estate investors use to build massive portfolios have been kept secret for decades. Now, because of this show, I'm going to reveal them to you. So let's get started.
Okay, welcome back, everybody. Yeah, like I was saying in the preamble, I get people that ask me all the time, like, how did you do it? What is the secret? How can I do that? This is why I started the Investors Growth Syndicate, which is a mastermind group that anybody in Canada can join. And I teach people these fundamental skills. And the bottom line is this: if you want to build a successful real estate portfolio, there's a lot you're going to have to learn. Now, I'm going to make it sound really simple in this broadcast. I'm going to tell you exactly what the 4 steps are that you have to follow and how to master these 4 steps. But the secret is, if you master these 4 steps and you get out there and you get active and start looking at properties, your portfolio will grow. The biggest part of the equation is learning how to raise capital and building the ethical responsibility into yourself to do good with that money. And if you can master that part, you're going to be incredibly successful in real estate investing. But let's get into it. Let's talk about this. So as I get a chance to talk about all the time, and if you're a subscriber on the YouTube channel, you're going to already know what I'm about to tell you, but there are 4 fundamental skills that you need to master if you want to be a successful real estate investor. Now, the people that are in the Investors Growth Syndicate community, they always talk about the fact that I make it sound really simple. And yeah, that's my whole goal in this podcast episode, is to make it sound really simple for you. So you're going to ask me for more information and you're going to want to know more about this. But it is really simple. It's not 10 steps. It's not 20 steps. It's 4 simple steps. So if you want to build this portfolio, here's where we start. Step number 1 is you gotta master the ability to identify undervalued properties. So when you go out and buy anything significant in your life, do you want to pay the top dollar for it, or do you want to get a good price on that thing? When you're out buying a new car and you're at the car dealership, you haggle over the best price. When you're out looking at anything you want to purchase in your life, you're always looking for the best deal. But why don't people do that when they're looking at properties? And there's a fundamental way you can do that to make sure that you know what you're doing. So when you're out looking at properties, there's lots of different places that a really good real estate investor is going to go to find great properties. Number 1 is the most obvious one. You're going to go to MLS. Go get hooked up with a really good real estate agent. Don't go try and use 10 agents. Don't call the agents that are on the listings. Go find a real estate agent that is a freaking amazing person and understand what real estate investors are looking for. In other words, go find a real estate agent that is also a real estate investor themselves. They'll get it. When you start looking at properties, don't look at what the property's worth. Go look at the property, see what they're asking for it, and then figure out what the property is really worth. How do you do that? It's really simple. Once you get a look inside of a property and you can see the condition of the property, is it in good shape? Is it dilapidated? Whatever that is, it'll give you a better understanding of what the value is. And then when you're there with your agent, if you like the property, you ask your agent to find some comparables. You say, I want you to go show me 3 or 4 different properties that have sold recently that are in this same state. Same square footage, same number of rooms, same size lot, and same dilapidated condition. They'll find it for you. They'll come back and tell you. I always ask my agents for 3 different comparables. And if they come back to me and they say the average price of the comparables for this property are $450,000, and I see that they've got this one listed for $600,000, I know they're asking too much money for it. On the other side of the coin, sometimes we see this happen. The agent will come back and say it's worth $450,000 and they're only asking $400,000 for it. grab it. That's a great deal. That's an undervalued property. Now, it doesn't end there. You can find amazing off-market deals, dealing with wholesalers, dealing with people around it. But even if you're going off-market and you're looking at a property that's maybe listed by a wholesaler or through some other means, go look at the property, go back to your trusted agent, tell them about the property, and get them to find those comparables. So that comparable analysis works in any format. The next step in really figuring out the value and making sure you're getting a good deal, it always starts with doing that independent research against comparables. But then when you see that the comparables make this property look like a good deal, now you put an offer to purchase it. You're going to put a minimum deposit in, as little as you can. And you can go back and forth until you figure that out. But there's 3 major conditions that I will put in any property I'm trying to purchase. Number 1, an appraisal. It's a non-starter. If they won't allow an appraisal, I want nothing to do with the property. Number 2, I'm always going to ask for 5 visits. 5 visits between when we agree on a purchase and sale agreement and when it closes. Because I want to be able to go back there in that time period several times with my contractors for whatever I'm going to do with the project. And number 3, the closing date. If I'm going to do a simple project where I'm going to flip a house, I want 90 days to close. The reason being is I want enough time to get the capital raised for the project. And I want enough time to finish my assessment in doing the project. If I'm doing a bigger purchase, like an apartment building or one of my resorts, I'm going to look for a 9-month closing. Now, some of you are going to be mystified by that, like 9 months. Who in the hell is going to agree to 9 months? Anybody selling a major piece of real estate, it's normal to ask for a 9-month closing. The other thing, in big real estate projects, I won't just ask for a 9-month closing. I'll ask for 5 months before I have to waive the conditions, because there's a lot more work you have to do in a bigger deal. But either way, step 1 is getting an as-is appraisal. I'll hire a company to go in and tell me what they really think it's worth. So if I've got an offer to purchase in at 400 grand and they tell me that it's worth 420 grand, boom, home run. You know you're getting a good deal. On the other hand, if the appraiser comes back and says it's only worth 300 grand, I'll walk away from the deal, because that purchase and sale agreement says subject to a satisfactory appraisal. It doesn't say subject to an appraisal that says it's worth X or Y or Z. So if they come back and they tell me that it's not worth as much as what I'm paying, that means it's not satisfactory to me. I'm going to walk away from that deal. The other part of what I do in appraisals is when I look at a property, if it's a little house flip I'm doing, I can figure out within a couple days how much I'm going to spend on renovations and what I'm going to do to the property. So I'll get that appraiser to do 2 appraisals at one time. One as is, and the second one, what's the value of the property after I finish all the repairs and upgrades? And they do that all the time. Most people don't realize appraisers do that, but they do it for banks all the time. They can do it for you. And when I'm looking at that property, I want to make sure that if I'm paying 400 grand for it and I'm putting 100 grand into it and I've got a $50,000 interest reserve, I'm into it for 550 grand. I won't buy the property unless the ARV value comes back $200,000 more than that. So that's 750 grand. If they say it's 600 grand when all the renovations are done, it means it's a bad deal for me to do, because that 100 grand buffer between what it's costing me, or sorry, the 50 grand buffer in the case I just gave you, where I'm all in cost at 550 and it's only worth 600, that margin is too small. Because something is always going to come up. I know if I have a $200,000 spread, we call that lift, then if something goes wrong and it costs me an extra 50 grand, I'm still making 150 grand. If something goes wrong and it costs me an extra 100 grand, I'm still making 100 grand. And I do the same thing with the resorts. I'll literally go get a resort appraiser. CBRE, Colliers is a great appraiser. One of those 2 will always work. I'll put together an entire plan for what we're going to do to that resort. I'll even put together financial forecast for what it's going to, I'll give it all to them and I'll say, tell me what it's going to be worth when it's done. For our big project, the Hay Bay Resort, we had CBRE do a full ARV, after repair value, or they call it a stabilization appraisal. And they told me it was going to be worth $56 million when it's done. You know why it's important? When you're selling a place, that ARV value will make sure you never get into a deal that you can't get out of. If you're going to hold something that ARV value is super freaking important, because if you're going to hold something, you're going to arrange financing in order to buy the property. But once that property is finished, you have to refinance it with a bank. And if you want to refinance it with a bank, you need to know what that value you're going to be refinancing is against at the end so that it'll work for you. So in the case of the Hay Bay Resort, the CBRE appraisal, they said it's going to be worth $58 million or thereabouts. And I have banks that tell me they'll lend me 60% of that value. So that's $35 million. By the time that resort is finished, we're going to have a total of $30 million that we have to pay back once we stabilize. So that means the deal works. So those appraisals are crucially important. But step one is making sure you've got something undervalued. And I kind of just gave you a good overview. Step two is raising capital. If you want to succeed and build a $100 million real estate portfolio, you have to become a master of raising capital, getting the money to do deals. And this is probably the hardest part. This is why I suggest strongly, if you want to build a big real estate portfolio, you need to join a really amazing mastermind group. There are incredible training companies right across Canada that teach people how to succeed and master the fundamental skills of being a real estate investor. We own an amazing community called the Investors Growth Syndicate. You can get started for a couple $1,000. And inside of the Investors Growth Syndicate, we have a whole online curriculum of online courses that talk about every type of real estate investing. There's a private Facebook group that over 500 real estate investors are in across Canada. We meet on Zoom twice a week. We talk about deals. We do live events, and you get access to all of that. The most important part, you get access to my fundraising directory. I have access to dozens of major lenders in the United States who love to lend on projects in Canada. My mortgage brokers, we have 4 mortgage brokers associated with the Investors Growth Syndicate that have 7,000 private lenders that will get you the money to do any deal. And so if you want the easiest journey in building a big real estate portfolio, you need to take a look at the Investors Growth Syndicate. And if I've got your attention by that, what I want you to do in the comments of this video is type "tell me more," and I'll send you a 60-minute video where you can watch and learn all about the Investors Growth Syndicate and see if this is the right next move for you. So step 2 is you got to learn how to raise capital. And there's lots of ways to do it. There are mortgage brokers in Canada that have access to private lenders, and these private lenders will give you 100% of the money to buy the properties, renovate them, even the interest reserves. They'll want to see that ARV value appraisal to make sure you know what you're doing, but they'll give you that money. If you want to buy apartment buildings and bigger projects where you got to raise millions of dollars, there's a couple ways you can do it. You need to set up a fundraising company or organization that is compliant with the Ontario Securities Commission. The best way to do it in today's world is called a mutual fund trust. And when you set up a mutual fund trust, it allows you to raise money from eligible and accredited investors, and they can use registered funds to invest in your project as well as their cash. Now, the second part of that is not just setting up the mutual fund trust. You need to be connected to an incredible EMD, stands for exempt market dealer. My company is associated with one of the best EMDs in Canada. They're called Parvis. Parvis has the ability to raise capital in all of North America. They're just setting up an ability to raise capital in the United States, and they're the ones that keep you compliant, so that anybody that wants to invest in your opportunity, they talk to the dealer representatives at Parvis or whatever EMD you're working with, and those people make sure everything stays compliant in the process. And there's a lot you got to learn. So what we did with our biggest project is we raised $10 million by selling equity in the business. We put that money into the project, and then we got a $20 million mortgage financing opportunity from a U.S. lender, and that's how we're finishing the project. But you got to learn how to raise capital. Number 3 is increasing the value of the property. Never get into a deal unless you know you can significantly increase the value of the property. How do you do that? It's those appraisals again. So you're going to look at what you're going to do to the property, what is the revenue that's going to make. You give all that to an appraiser, and they give you the value of it. And you should be starting to see now who a professional real estate investor's best friend is. It's the appraiser. Number 4, the last thing you've got to master is the ability to exit. My very first mentor 25 years ago, who taught me everything I know about real estate investing, he said to me, Ken, never get into a deal unless you know how you're going to get out of the deal. So if I'm doing a house flip, I've got an ARV appraisal that says when it's done, it's worth $700,000. If I do all the renovations, I close on the property, do all the renovations and list it within 6 months, we should be bang on point with that value. I sell it for that value. I make money. That's a properly orchestrated exit. If you're doing a buy and hold, if you're buying an apartment building, you're going to get an appraisal done, an ARV appraisal that's going to take into account the rents and everything. It's going to tell you what it's worth on the end. You don't buy that building if that ARV value isn't high enough. You know, in Canada right now, there's an amazing program for apartment buildings called CMHC-MLI Select. They'll lend up to 95% of the money if you're qualified. So you got to figure all that stuff up front, know what you're doing, and as long as your appraisal comes back, you arrange your takeout financing, you pay back all of your construction financing, and you move on. These are the secrets, friends. And you know what I find fascinating is I meet real estate investors all the time that have never been taught properly how to do it. They go out, they make their mistakes, they lose money doing deals, they try to figure it out, and inevitably they all get stuck in a deal that didn't fund properly and wasn't worth as much, and they get screwed. Don't let that happen to yourself. If you learned something new in this session with me today, that means you're getting started on your journey. Or that means I can teach you how to do this the right way. Inside of the Investors Growth Syndicate, we have a team of subject matter experts. We've got a couple people that have massive apartment portfolios, multifamily portfolios. We got a couple people that own hotels and resorts. We got a couple people that are experts in wholesaling. And all of these people together are the curriculum teachers. So these people will help you to succeed. It's called the Investors Growth Syndicate. We want to get 10,000 new people into real estate investing and make sure they do it the right way. And if what I've said in this video has caught your attention and got you a little bit excited and you want to build a big real estate portfolio, I mean, why wouldn't you? You're going to make more money in your life and you're going to have tangible assets that you can leave to your kids and the people you love when you're done on this earth. And if those things have gotten into your heart, then go into the comments of this show and type "tell me more." I'll send you a 60-minute video that'll explain all the benefits of the Investors Growth Syndicate. And if you decide you want to be a part of it, you'll be given the opportunity to book a private live one-on-one Zoom session with me where I'll answer all your questions, get to know you, and we'll see if the syndicate is a right fit for you. Hey friends, if you like the things I've gone about in this video, if you're watching this on YouTube, smash that subscribe button and become a subscriber. Go on this journey with me. If you're listening to this on one of the podcast channels, make sure you give us a review and help keep us encouraged to create more content like this. We'll see you soon.